We don't have a pattern big enough for in between 333 and going single digit gold silver ratio. China is paying $83.43 for silver right now, and the West is selling it. The casino price is $75.66. The UK imported 601 tons of silver from the US in March and immediately exported all of it to China and India. So China is draining the COMEX via the LBMA. Singapore is going to launch a futures contract on silver.
Coming out of India, Prime Minister Modi going on TV and imploring his citizens to stop buying gold for a year.
So if he says don't buy gold, it means we're going to have a currency crisis on the Indian rupee. Sell your rupees, buy gold. Reduce your fuel consumption as well. The more energy they consume, the more they have to import. China runs trade surpluses with most nations. You reference Chinese debt and why the interest rates are low. Well, they had a property crisis, but also they're good for backing it. They are net stacking bullion.
I want to kick things off today with the silver market, because last time I had you on the show, you pointed out that increasingly it was the Chinese market that was setting the real price of silver as opposed to London and New York. How has that situation developed since the last time we spoke? And what is your overall outlook for silver in 2026?
Yes, so two questions in there. The first part, let's deal with that first. That's ongoing, and it's not opinion piece on my behalf. That's essentially what we're seeing out of news flows. It's public domain knowledge if you care enough to watch. In fact, I've got a couple of super quick, if you're just on X and you're inquisitive enough, you can go do the search and you will see China silver imports. Let's just run the headline super quick for you. China is paying $83.43 for silver right now, and the West is selling it. Well, I say selling it. The casino price is $75.66. Good luck if you want to try get that price in ordering an ounce yourself. You won't get anywhere close to that. Same metal, you're almost $7.77, lots of sevens in that one. That gap has existed for 7 months. So quite clearly there is a migration. When you have a disparate pricing, yes, there's some frictional costs that don't make for a perfect arbitrage. But quite clearly there's a migration. Demand sets price. The demand is higher in the place that is looking for monetary metals and also one of the most instrumental key industrial metals.
The bigger warning is not silver's price, but who may be quietly deciding that price now. Francis Hunt notes the reported pricing gap between Eastern demand and Western paper benchmarks highlights a structural trust problem, not just volatility. When physical premiums persist while headline quotes stay softer, it raises questions about whether paper markets still reflect real scarcity. For long-term holders, this matters because delayed repricing can punish anyone relying on headline charts alone. Next, Francis Hunt exposes what shifting physical demand may reveal about who controls true silver discovery.
In the green agenda, the solar panels and everything else, in a time where we're having an AI boom, that suddenly climate change doesn't matter, we just need energy to fund data centers. So, a bit like how Putin killed the climate change thing when he invaded Ukraine. He killed the CV-19 tail of 2022. It seems like the AI data centers has killed the climate change for now until they need it back again. But that's what's happening in China. The other thing is a couple of other comments. All these are people I follow and that are reliable. The UK imported 601 tons of silver from the US in March. But let me just stop those in the United Kingdom getting too excited, and immediately exported all of it, near all of it, to China and India. So China is draining the COMEX via the LBMA. That's another key point. Also, more interestingly, is Singapore is going to launch a futures contract on silver. I've often said that Singapore is the acceptable face of the rise of the East in terms of their role in the global economy. And with that key post, I would say, you're looking at them becoming far more significant in terms of pricing. So you're going to have a lot more pricing going on, combination of Singapore, Hong Kong, Beijing. You've got a much more in terms of flows, in terms of the price that is being offered to have it landed in there. You've got a lot of silver that's leaving London and the US, and that is going into India and China. So that is the migration east of real sound money. So I think we've dealt hopefully with both parts of your question there.
When metal moves east while pricing hubs begin multiplying, timing matters more than headlines. According to Francis Hunt, large silver flows toward Asia and emerging pricing centers suggest the market may be redistributing influence before most retail investors notice. If supply routes shift while futures infrastructure expands, institutional positioning often changes before media narratives catch up. Savers watching only COMEX headlines could miss where pricing power gradually relocates. Next, Francis Hunt unravels why volatility may be signaling structural repositioning rather than random market chaos.
Yeah, absolutely. Now, silver's obviously been on a very roller coaster ride when it comes to the price action. We saw it rise, of course, to new all-time highs in January this year, getting well into the triple digits. I think it closed at around $116 on its strongest day. Following that, it fell 26% in a single trading day. And we've kind of made a bit of a comeback and been largely consolidating sideways since there's silver also taking a hit in the aftermath of the start of the war in Iran. I know price predictions are a mug's game, but do you think we get back to that triple digit number and perhaps even all-time highs this year?
Yeah, another good question that many people will be sitting on. And quite a few people have felt a little disappointed in silver's recent performance, forgetting that the break began really at the $25 mark and didn't stop running and actually went all the way to 121, I believe it was, up top here. So I put some lights on and you'll get the measure. This is on a weekly chart. This is the silver chart on a weekly. And you went as high as 121 in that period, 121.64. You then had that 64 crash you referenced, 96 rally back down to 61, a marginally lower low. So we have, in terms of our technical analysis, I'm going up to quite a big time frame here. There's a couple of drawings and annotations on this, and I'll just stretch this out so that everybody can see the key bit. Our overall take, remember, and I think I did this with you, though.
A sharp rally means little if investors ignore what violent reversals usually expose. What Francis Hunt is highlighting is that a 26% collapse after a major spike often reflects leverage stress and fragile conviction beneath bullish headlines. Sideways consolidation can look calm, but historically it can also hide institutional redistribution before the next decisive move. For retirement-focused holders, protecting capital matters more than chasing emotional breakouts. Next, Francis Hunt reveals whether this consolidation is building strength or masking deeper weakness.
People would have to look at previous watches. When we look at the quarterly chart, this is a weekly chart. Quarterly means 3 months. Every candle is 3 months. We explained to you that you have a target for 333 range and beyond in the cash price. We also mentioned that the second interim level is going to be kicking in from the late 90s to about 105, and that's typically when you get a pause. That's on HVF method, on the big HVF draw. That gave us that 333. We never called that the top. We said we'll probably go single digit, and we've even got point and figure targets because we don't have a pattern big enough for in between 333 and going single digit gold silver ratio. But so this pullback is expected and was due. And people forget that this is a quarterly chart on the macro setup that we had, and you're in a gestation period. Overall, the structure for us has looked and has consistently represented what we describe as a falling wedge. That is a technical structure that is normally associated with upside continuation when you come up into it like that. We talk about a splitter, which is a line that breaks it into three. And we talk about the rule of three key sell-offs. In other words, we talk about 3 impulses in a falling wedge like this. And what's actually happened is we just had a massive rejection. So I'm just going to take those last 2 lines away to bring you into the future. We had what looked like a breakout. We took it and we cut and run, thankfully, and was able to leave with some profits because we were expecting the possibility you could break out from this. But when you look on the weekly chart, this rejection.
Breakouts become dangerous when the market appears bullish, but rejects conviction at the worst possible level. Francis Hunt's argument suggests the failed breakout and falling wedge structure may be less about hype targets and more about timing risk before real continuation. Many traders obsess over upside projections while ignoring that false breakouts often flush weak positioning first. For wealth preservation, misreading technical patience as certainty can become expensive. Next, Francis Hunt exposes whether this rejection was healthy reset, or warning the larger thesis is being tested.
That it turned out to be in the end. And what happened for that rejection? Well, an increase in hostilities, a possibility of an attack, the complete theater that goes on there and the cacocracy of moving markets by statement. So if oil price goes up at the moment, even though they're both commodities priced in dollars, if oil goes up, it means rates higher on bonds. And please, we must talk about bonds, US gilts particularly, but long end, mid end, and short end across the world. So I'll just drop that thread separate to follow up. Yields go up and bonds collapse, and that causes a massive problem. But it took the foot off. The whole Hormuz came in when the silver squeeze was getting too intense. Suddenly we had the contrived event, which is actually a supply chain, an agreed cross-nation supply chain throttling that brings stagflation and even a more extreme version of that, because that's how they impoverish you and enrich the billionaire class. So drill down anywhere you like on that later. But what we got was we put a brakes on gold and silver's run, and we now push the commodity of oil up, and now that pushes bond rates up. And that, of course, so while it looks like some people were claiming 5D chess on Trump's behalf, what it's actually done is made funding and refinancing debt a whole bunch more expensive in the US, and the focus is moving ever more harshly onto the debt markets. So if the debt market starts to collapse, you will see a rush back into metals as the final reserve asset. So in the long end, you might postpone, but you don't cease the eventual ascent of the silver and gold markets. Technically, this was a big rejection candle, and we leave the possibility open that you could go lower first.
Oil spikes get blamed on headlines, but bond stress is often where real capital panic begins. This is where Francis Hunt's thesis shifts from commodity volatility to a broader debt refinancing pressure point that many retail investors underestimate. When higher yields tighten liquidity and make sovereign funding more expensive, metals stop being just inflation hedges and start resembling reserve protection. Institutions usually watch credit strain before they react to mainstream narratives about commodities. For wealth-focused investors, debt market instability can reprice everything faster than sentiment. Next, Francis Hunt exposes whether bond pressure is quietly becoming the bigger catalyst than silver itself.
Before you eventually get the falling wedge break. That would be a demand-destroying event. We mentioned May, sell in May and go away. One key trend, which is negative for equities, negative for risks, any form of risk, which could see bonds again come into trouble. The higher the rates go, it leans a bit initially on the metals markets. They don't pay a yield in due course. In traditional terms, but in the long term, they preserve value. And of course, the higher yields crash stock market. It causes liquidation, and people sell their best collateral to support their losing positions, sadly. So you get an initial sell-off in the metals. The longer run effect is metals will go higher. So we are waiting a third possible sell-off here, for which this was a rather ugly rejection candle here that didn't follow through on the breakout of the falling wedge. How low does it go? It could bounce on our splitter and be medium-sized. If we have a big demand-destroying event and a lot of stress, you could come right down to the lower level. But overall, the medium macro move is, medium long-term is a break to the upside for this. And once we're done with that second interim, a very brisk open territory move to the 333s, where we will pause again, much like our second interim, only even possibly a bit longer during that period. So let me hand back to you, because there was quite a lot in that.
Markets can punish metals short term, even when the longer macro thesis stays intact. As Francis Hunt points out here, rising yields can trigger forced liquidation before hard assets recover as confidence in financial instruments weakens. That contradiction matters because many investors mistake temporary weakness for thesis failure instead of stress repricing across portfolios. A rejected breakout can still be noise inside a larger structural move if liquidity is being drained elsewhere first. For savers, patience often matters more than reacting to fear candles. Next, Francis Hunt reveals whether this sell-off is cleansing leverage or delaying the stronger breakout.
I want to switch over to the gold market now and discuss some pretty shocking news coming out of India, which of course is Prime Minister Modi going on TV and imploring his citizens to stop buying gold for a year. What is behind this? I mean, this guy's talking about protecting the Indian economy. Meanwhile, he's gallivanting around the world, going to visit all these different politicians in different countries and posting about, oh, wow, look at the Indian culture in whatever, Norway or Italy or whatever. I mean, guys, these politicians are all just parasites. Let's make that clear. What is the deal here? Because Modi, of course, has said, for the next year, I would like you to stop buying gold. And we all know how governments work, that well, what's the quote? There's nothing so permanent as a temporary government program. I mean, moving forward, do you think they could move to eventually ban citizens from buying gold or establish some sort of quota system where you're only allowed to buy so much gold per year? And ultimately, what do you think is behind this proclamation?
So inherently politicians, we always apply the law of inversion perversion, by the way, the Hunt's law of inversion perversion. That means do the exact opposite of what they're telling you. So if he says don't buy gold, it means we're going to have a currency crisis on the Indian rupee, buy gold. Sell your rupees, buy gold. And by the way, that's happened before in 1967 with the Gandhi. And they said the exact same statement. So this is a repetition of cycle. In 1967, Gandhi came out. And in fact, I can find that tweet. I will narrate it to you anyway, but it's worth people once again seeing this is historical facts, not something I'm conjuring. They said in 67, to protect our foreign reserves, because, you know, we don't export enough. They import all their silver and gold, most of it. They aren't big miners, and they import their energy. So they have a lot of base needs.
When governments publicly discourage hard asset buying, investors should study the motive, not just the message. Francis Hunt notes that policy language around gold restrictions often gets interpreted as economic confidence. Yet historically, such rhetoric can emerge when reserve pressure or currency concerns intensify. The deeper contradiction is that official reassurance can coexist with underlying fragility in trade balances or import dependence. Long-term holders should focus on whether policy behavior aligns with monetary stability, not emotional headlines. For wealth preservation, signals around capital behavior matter more than speeches. Next, Francis Hunt unravels what reserve pressure can quietly reveal before currencies absorb the damage.
That require imports that put immense pressure on the rupee. And as you see the rupee devaluing, which it is, which I will show you a chart for in a second, of course, the people do what they naturally do, the smart ones at least, and they set out to preserve their buying power. And that often involves bringing gold into play. So let's just have a look at that. That was Modi. Reduce your fuel consumption as well, because the more energy they consume, the more they have to import. Don't buy gold, work from home, appeal of people. That is a reserves crisis. They lack foreign, so all fiats are flawed, but some are even more compromised. For example, China runs trade surpluses with most nations. That means you reference Chinese debt and why the interest rates are low. Well, they had a property crisis, but also they're good for backing it. They are net stacking bullion at an epic rate. People don't fear complete confiscation and loss of money in the Chinese bond market. They also had a property crash. There's other reasons. They haven't been perfect. There is no perfection anywhere in the world of fiats and debt, but that's why they can afford lower rates. I was shocked to hear some experts saying, yeah, they're in a depression and the US economy is great because we're at 4.5%. No, it's the pricing mechanism for likely default and debasement that is in place. And the US has to price a lot cheaper and offer a lot higher yield on account of its excessive position in that market. So again, the West is losing on that front, and India is not as in a stronger position as other BRICS nations like China.
Currencies rarely warn savers politely before purchasing power starts eroding. According to Francis Hunt, pressure from imports, weaker reserves, and monetary imbalance can push people toward hard assets as protection rather than speculation. The overlooked issue is not simply gold demand, but whether trust in fiat durability weakens while policymakers still frame stability publicly. Trade strength, debt pricing, and reserve flexibility often matter more than headline GDP optimism. For families protecting wealth, the real risk is staying overexposed to assets that assume stable currency confidence. Next, Francis Hunt exposes which monetary imbalance may matter more than inflation headlines.
In terms of this, the rupee is under pressure. So I mentioned, let's have a look at it. Let's first deal with the gold question as well, and just show you what I fear is still to happen. I mentioned 3 waves of selling. For me, the continuation pattern here could be in the category of what we'd describe as a channel bull flag. You had a big sell wick here on this is again a weekly chart of gold, by the way. You had a big sell there where you went from almost 5.6 down to 4.4. That's the better part of $1,200. That's quite some correction. And then you had the 5.4, a little bit lower, going to a new low at 4.098. And then you've rallied moderately, but without too much enthusiasm. You're in the channel, and now you're grinding along the channel, and you had a bit of a rejection here. So there could still be a third sell-off. We talk about the 3 waves of selling before you break. You could come down here and break eventually, or you could come down a bit deeper if we had a really shocker demand-destroying event such as the NASDAQ and the AI boom crashing, which I think there's real motives. You've got Michael Burry with $1 billion short, most of it on Palantir. You've got Warren Buffett that's been a net seller, and his successor, a net seller of stocks for better part of 5 years, and the accumulation of cash. So there would be effects to precious metals of very steep demand destroying event, by the way. And it is also the perfect environment for them to bring in their CBDCs. I know you have a question at the end on that, so I'll leave that there. But so for me, generally, gold looks a little bit precarious, like it could go downside.
A rising market can still hide weakness when momentum fades into hesitant recovery. What Francis Hunt is highlighting is that repeated sell waves and weak follow-through may reflect caution beneath bullish assumptions, especially when broader risk assets look stretched. Investors often chase charts while ignoring that cash buildup. Defensive positioning and slower conviction can signal institutional restraint. If macro stress spills from equities into liquidity, gold can briefly correct before stronger demand returns. For disciplined holders, volatility is only dangerous when mistaken for direction.